Hello, hi everyone. Can hear me? Yes, and can see a screen as well. Yeah, 60 of you all can hear me. Okay, perfect. So we'll wait for a few minutes till maybe the others also come in. So if you'll have friends on the group and if they're not here, but search and see if they're here or not. Uh, if they're not there, just give them a call and remind them because apart from the revision students, others will not get the recording. If it's missed, it's missed, it's gone. So just in case your friend has forgotten, just remind them. Small things like that can go a long way. Maybe next week, if you forget, your friend might remind you. Sound is too low. Is it low? Yes, in general, is it low or is it the same as it's there before? Same, right? Okay. If in case someone's having any issue, I think only a very few are having a issue with the sound. So I don't think it's really my issue. So what you can do is maybe try leaving and joining back, or maybe try maybe the best advice is try to connect to an earphone. I think you should get uh, a better volume. I'm hoping. Okay, so just want to check with you all. We're going to start the part two questions today, right? The part two questions of unit number 4. I'm hoping you all are following and you all know where we stand, right? Revision class students, all the recordings are there in a Google Classroom. If you all have missed, go watch. The others, I'm hoping you all are but on track, following little by little. Okay, I'm getting answers already. Nice. Okay, give me a second. In the right. Uh, okay, so you did up to 2016. Okay, I just want to check. Can you all? Okay, I don't have a question. Give me a second. Okay, no, that's not take long time. Okay, so did you all do up to at least up to 2016? Yes, no? Because I'm not going to give you time to do. I'm only just going to discuss did at least minimum until 2016. Because ideally this week and maybe the next class we will finish. I might have an extra class somewhere around the corner because we missed class last week, right? You all also were celebrating Valentine's. I was also celebrating Valentine's. So we didn't have class last week. So we might have an extra class somewhere around the corner. If there is something, I'll let you all know. If not, our normal time, that is where we will go, right? So this class and probably the next class, we will finish unit number 4, right? So 4 units done, and then we'll move on to unit number 5, 6, and so on, right? Okay, I'm hoping everyone who wanted to join is here. It's 2, 3. Let's start. If I can finish until 2016, if I can finish early, right? Class will finish at 4. But if I can finish earlier, I'll finish the class before that, right? So I'm with the impression that you all have done the questions and also with the impression that you all are not studying this unit for the first time, right? That you all have studied the unit and you all have done the question. So I'm only here to clear the doubts off and explain the questions, not explain theory from the very beginning, right? So anyone who is learning this unit for the very first time, this class is not exactly for you. Maybe your ideal thing would be ideally join a revision or a theory class. Okay, right? So 2011 A levels unit 4, right? It comes with question number 3. Okay, so first of all we start question number 3 part 1. Distinguish between short run and long run in production. Now see, they're only giving you 2 marks. Don't go and write paragraphs and paragraphs when they're only giving you 2 marks for a question. So what is the difference between the short run and the long run, guys? Yes, short run and the long run. Okay. So in very simple terms, remember in economics, in unit number 4, when we are defining short run and long run, it's not about, the number of months, number of years, number of days. It's not about that, guys. Short run and long run means in the short run, we say, right? So answer number 1, I'll just give you the key point, right? In the short run, we say, when you produce something in the production process, right, at least one factor, right, at least one factor of production is fixed. At least one factor of production is fixed. So generally, it is assumed what is fixed, labor or capital. That that capital is fixed. So generally, we say that capital is fixed. And then if you want, you can add into that, you can say, therefore, in the short run, therefore, in the, I'll say SR for short run, there are both variable and fixed factors. So this is one of the easiest questions you can ever get, right? Wait a second, spelling is wrong. Variable and fixed factors. There is nothing more. Don't go to write more than this, right? Because they're only giving you 2 marks. So maybe 1 mark for this, and then say, what is the long run? So for long run, what is the long run, guys? The opposite of this. So in the long run, that is where all the factors of production, right, are variable. So we can say long run, this is the time period. This is the time period where all factors of production, right, where all factors of production are variable. So in addition to that, you can say there are only variable factors and things like that. So something like this is more than enough for 2 marks. Don't go and write more because you're wasting time then. See, they're only giving you 2 marks. They'll give you 1 mark for this. They'll give you 1 mark for this. You don't have to, talk about what is the laws and what is the short run law of diminishing marginal returns. You don't have to explain that long run law of returns to scale. You don't have to go and explain all of that because it is just a 2 mark question. If it was maybe a 4 mark question, you can go one step ahead. You can talk about, what is the laws governing each of these stages, right? You can do that, but not for a 2 mark question. So you stop there. Then again, question number 3, part 2. Part 2 is saying, explain the law of diminishing returns. Now, law of diminishing returns. So what is the law of diminishing returns? I've simply given you the answer that is there in the answer scheme. Now see, this question also, because I'm a little lazy to type, this question also is a 2 mark question. So don't write pages and pages of paragraphs and paragraphs. One small paragraph to the point, right? That will give the meaning of this is more than enough, right? They're not expecting you to write pages and pages. So please don't do that. You don't have to draw diagrams. You don't have to go and explain, let's say, stage 1, this is what happens. Stage 2, this is what happens. All of that, you don't have to explain. You can simply explain the brief meaning of what it is. So the answer scheme says, right? You all know law of diminishing returns, the law governing the short run. So what is happening in this law of diminishing returns? When you add, right? Remember, in the short run, you have fixed inputs, right? Fixed factors. So to increase your production, the only way you can increase your production is by increasing variable inputs. Now, for example, when I explained this in the revision class, I said we have one big printer, and to increase the number of printouts, that is our output, what we can do is increase the labor. That is our variable factor. So according to the law of diminishing returns, it states that when you keep on adding variable factor to a fixed factor. So for one printer that we have, if we keep on adding labor, what is going to happen? Eventually, the marginal and average product of the variable input will begin to fall. At the very beginning, it will rise, but eventually it will begin to fall. Then you can talk about the 3 stages if it was a 4 mark question. Now, this is more than enough for a 2 mark question, guys. Don't go write extra because this is where students lose time and then, they say, sir, I didn't have time. This is the economics, very rarely people lose time, but there are still people who go and, write too much. That does not mean, yes, I know you all study. I know you all have gone through everything in detail. You all know the stages. You all know how the diagram looks, right? But 2 marks now, you keep it for 2 marks. Don't go write extra, right? So simple, like a definition there is enough explaining what it is. Okay. So far, are we fine? Yes. Yes, I'm with the impression that you all have done the paper and you all have some sort of understanding, right? That is why I'm not explaining in detail what these laws are. Okay. Then question number 3. Okay, very easy question. This is always kind of tested. Accounting profit, economic profit, explicit cost, implicit cost, right? This story is usually always tested in past papers. Now look at question number 3. Explain the difference between explicit and implicit cost, giving examples. What is explicit cost? I've got a perfect answer. Anyone? Explicit cost. Explicit cost. What is another name for explicit cost? Explicit cost, in another name, exactly, direct explicit cost, right? Another name for this. Now don't go and say explicit cost is direct cost. That will not give you marks, guys, because it's another name, no, right? So explicit cost is direct cost, you will not get marks, right? So sometimes, I've seen students, when they say what is a PPC, they say PPC is the production possibility curve. Now, that is not going to give you marks. You're just telling what the abbreviation means, or you're just giving another name. That will not give you marks. So explicit cost is what? The cost, right? Or the money spent to purchase inputs from outside the firm for the production process. I'm copying answers that is there on the chat box, so I don't have to. Right. So explicit cost, guys, is the money spent, right? All of you all gave me almost the correct answer, right? It's simply whatever money that you spend to purchase inputs from outside of the firm, right? So what are these now? Examples, let's say the wages that you pay, right? So let's say examples, let's say wages you pay. Let's say your electricity bill, right? I'll say electricity. So maybe let's say any other utilities, right? Let's say your cost of raw materials, right? Now, all of this, it is not there in the firm. No. You're getting it from outside. So when you're purchasing these inputs from outside, you have to pay some amount of money. Yes, insurance, right? All of those are explicit costs, direct costs. There is a direct money flow. Now, why do we call it direct cost, guys? Because there is actual money going out. Now, for wages, right? For employee salaries, electricity, raw materials, right? For all of these, you have to directly pay money, right? So therefore, these are considered as direct cost. Depreciation is not explicit, guys. Depreciation is implicit cost here, right? So that is explicit. Then what is implicit cost? Anyone? Implicit? Implicit, what is, okay, first of all, what is another name for implicit cost? Implicit cost, another name is indirect cost. So what are these? Now don't say, remember when you're writing your answer, don't say implicit cost is indirect cost, right? So what is implicit cost, guys? Implicit cost is the cost, okay, the opportunity cost, right? The opportunity cost of using the firm's own inputs, right, in the production process. So if you use the firm's own resources or firm's own inputs in the production process, there is no direct cost, but there is some sort of an opportunity cost, some sort of an indirect cost there, right? So examples, what are the examples that we have? Exactly, what are the examples? Okay, so foregone rent. So let's say you own your building, right? Okay, now let's say I am doing this class right now. I'm also engaging in some sort of production process, right? Because I am doing this class here for, let's say, 2 hours, right? I could have, let's say, missed some sort of another income. I could have gone and, let's say, done something else and, let's say, earned some money. But because I am doing this class for you all now, right, I am missing some amount of money. So that is foregone income. Now, foregone rent is if I'm using my own land. So you have foregone rent, you have foregone income, right? Then we can have normal profit. Remember normal profit, the minimum profit the entrepreneur expects in the production. You can have depreciation, economic depreciation, right? So all of those are examples. So if you explain this part, it is more than enough, guys, right? So yes, I get income from these classes also, but whatever said and done, even though I get an income from these classes, since I'm doing this, I'm letting go something else. So there is a foregone income also. Yes, let's say from this class, I am let's say getting 500 for these 2 hours, right? But instead, if I could have done something else and let's say earn 400, now I am giving up that 400 now and coming and earning this 500. So there is a foregone income. I'm not saying that I'm not earning anything from this. I'm saying there is some sort of foregone income, not that I am giving up nothing and coming for this. Yes, rent can come under explicit cost. So remember, explicit cost, there is a direct monetary payment, right? Directly money goes out of the business. But for these, now foregone income, foregone rent, normal profit, economic depreciation, there is no direct money involvement. That is why we call it a indirect cost, guys. Okay? So that is the difference. That is the answer that you have to write here. Difference between explicit and implicit, giving examples. So you define what these are and then you take in this. In addition to that, maybe you can write one more point. What is that point that you can write in addition to this? Apart from defining and giving an example, one simple point that you can write, maybe to make your answer a bit more, complete. What do you think we can write? Can we say that accountants consider only direct cost when calculating profit, but in economics, right? Economists will say consider both direct and indirect cost. So you can say something like that. So I'll add that point also. You can say accountants, or in accounting, right? Accountants consider only direct cost, right, when calculating profit, while economists, or while I'll say in economics, they consider, it's stuck, okay, they consider both direct or explicit and indirect cost. Direct and indirect, guys, not only indirect. Remember, in economics you consider both direct and indirect, not just one of these. Okay, so usually which profit is higher, accounting profit or economic profit? Which profit is higher? Usually it's, guys, it's the accounting profit that is higher. Because why? Accountants only consider direct cost as expense. So from the revenue, they minus only a little. But in economics, they consider direct cost and indirect cost. So in economics, their profit is much less usually. If there is an indirect cost, the cost is high for them. So profit is your revenue minus your cost, guys. So that part is, that will come into profit parts also. So that is the difference between explicit and implicit cost. Very, very easy, guys. These questions are. Okay. That is also done. So then done. Then we have, what are economies of scale and how do they arise? Now, what is this economies of scale? Okay, economies of scales happens in the long run or in the short run? First thing you have to know, guys, economies of scale happens in the long run. That has to be the basic understanding. If you don't know that, then there is an issue. Economies of scale is where, guys, right, in the long run. So when the firm is, increasing its, let's say, variable factors, fixed factors, when it's increasing everything and carrying on production, right, now it's doing bigger production. It's doing large scale production, right? So when this large scale production happens, guys, the long run average cost, right? The long run average cost starts to fall. So when the long run average cost falls or decreases, as the rate of output increases, firms experience economies of scale. Your keywords are, one, it has to be long run. Another keyword should be average total cost falling. That has to be there definitely, right? There is no answer without those words. And then you can say, yes, as the output increases, right, when you're producing more and more, the fall in the long run average total cost is called economies of scale. Now, see, that is a 4-mark question. You can't stop from there. You have to maybe go on and say, there are a number of sources of economies of scale. Why do we have economies of scale? Why is this long run average total cost falling? The long run average total cost is falling, number one, because of technical economies of scale. That is where, right? Because now you're a large scale producer, you are able to get new sort of machines, new equipment. So these new equipment are more efficient, right? They can produce better quality things. They can produce things faster, which is resulting in a drop in your average cost, right? Then managerial economies of scale. When you are a large scale producer, when you're producing large number of units, you are now earning a lot of money, right? So you can hire specialist managers, let's say a marketing manager, a finance manager, let's say HR manager, who can, properly, let's say, organize the production and do a better job. That will also result in your long run cost to fall, right? Then marketing economies of scale. Marketing economies of scale is where, now say, now for example, right? Let's say you're a small firm, right? You're a small company. If you want to advertise, let's say in Sirasa during, let's say, the peak hours, let's say the news time, right? Usually to display one ad at that time, it costs around 500,000, right? Small firm. But let's say you're a big firm, right? So let's say for a small firm which is producing only, let's say, 1,000 units, they're producing only 1,000 units. So if you look at the average cost for advertising, right? So let's say to run the ad, it takes 500,000. So the average cost to advertise, or average cost per unit, is 500,000 divided by 1,000. That is equal to 500 rupees. That is the average cost. But if you look at a big firm, let's say there is a big firm that is producing around, let's say, 100,000 units, right? So for them, right, still, if they are advertising in Sirasa, for them also the cost is same. No? So for them, it's 500,000 divided by 100,000, the number of units. So for them, the average cost is only 5 rupees. So that is what we call marketing economies of scale, right? Where when you are a large scale producer, right, your marketing cost also falls per unit. Okay. Then you have financial economies of scale. Financial economies of scale is where when you are a large scale producer, now you can, when you're getting loans, right, you can get these loans at a lower interest rate. Now, let's say a small fellow goes and asks for a loan, right? Bank is not sure if this fellow will repay or not, and all of that. Bank will say, okay, 15%, you have to pay interest. Now, let's say a huge company, let's say a company like, let's say, Coca-Cola, or let's say Apple, is going and asking for a loan from a bank. Now, when Apple goes and asks for a loan from a bank, guys, now what happens? The bank definitely knows Apple will repay. And Apple is asking also for a huge amount of money. Bank knows definitely this is a profitable thing. So banks will now compete to give that loan to Apple. They'll say, one bank will say, no, I will give it to you. Other bank will say, no, you come to me, I will give you the loan. Because they know Apple is going to repay. Apple is a big company, large scale company. So they will, how do they compete? They compete by saying, I will give you a low interest rate. You come and take the loan from me. So when you are a large scale producer, you also get financial economies of scale. At a cheaper rate, you get money. And then you have risk bearing economies of scale. Guys, risk bearing economies of scale is where, right? That is where, right? Now, when you're a large scale producer, guys, the risk is less. No, you are doing different types of things. No, you are into different sectors. So even if one fails, the other one will kind of pick up. But if you're a small company, that is not there. So because of all those reasons, right? I'm just giving you a little bit of detail in case they ask you, the types of economies of scale in detail, right? So that again causes this average long run average cost to kind of fall. Okay, so all of those are the sources of economies of scale. So there's an alternative answer also. I'm not going into that part. Is that okay? Yes. I'm hoping I was not too fast. I'm hoping you all knew what economies of scale, and I just brushed up your knowledge. I guess I'm repeatedly saying that because otherwise you all would think that this is the way I teach. This is not the way I teach for someone learning it for the first time. I'm just brushing up your knowledge. Please have that in mind. right? Short written explanation. Guys, this is the written explanation. This is the answer that is there in the marking scheme. So for this, if you want a detailed answer, Google it, it's there. Sources, just Google, guys. That's a one very good option, right? I've told this my revision class students even 100 times, right? If you want to learn something, right? If you want to learn more, just Google, guys. You don't have to depend on a teacher or depend on anyone else. Just Google, just say sources of economies of scale. These will be detailed explained, right? So do that on your own. I can't force you all to do that now. Okay, so do that. Fourth question done. Okay, into the types of economic scale also. Yes, you kind of have to, because here they're asking, no, what are economics of scale and how do they arise? Now there is this part, how do they arise part. So the sources of economics, this is a 6-mark question. So what are economies of scale? You can explain long run cost forwarding. You can even, let's say, draw a diagram and show. That is fine. But here they're asking, no, how do they arise? So for that, these sources are important. That is why they see a number of sources. This is how they arise, because of technical economics, because of managerial economics. That is why I went a bit in detail and explained this also. Maybe even if you explain, it's fine, right? So keep those in mind, guys. Look at the question properly. See how is the question broken down, and also look at how many marks they are giving. Because based on that only you have to answer. Now, if it was a just simple question, say what are economies of scale and given 2 marks, then I will not talk about all those sources and all of that. I will just say in the long run, average cost is falling. This is what happens, right? Be very, very specific. Otherwise, you are losing time, or otherwise you are writing too less. Okay. Okay. Final one. What are the 4 types of market structures? Explain the distinguishing characteristics of any one of them, guys. This is one of the easiest questions you will ever get in your A-level paper, I'll say, right? So 4 types of market structures, right? Perfect competitive market. Guys, I'm not going to type, right? So should we further explain the sources of economies of scale? Maybe if you want to, you can, right? But it's better if you can explain the sources of economies of scale. Okay, so what are the 4 types? Because I'm not going to type this answer, right? If you're still unsure of this, that means you have to start studying, right? 4 types of market structures. We have perfect competition, we have monopolistic competition, we have oligopoly, and we have monopoly, right? This is an entire section in your unit number 4. Then the characteristics of any of that, right? Go with perfect competition. That's the easiest, right? So let's say perfect competition, you can write on any of it. Doesn't have to be perfect competition. I'll just say the characteristics of perfect competition. You can say large number of buyers and sellers. You can say homogeneous product. You can say, let's say, the firms are price takers, right? Then we can say there is perfect information in the market, right? What else can you say? You can say no advertising kind of things, right? So all of that you can, okay, exactly, free entry and exit, right? No barriers to enter and exit. So things like that you can write. So simple, simple, simple as that, right? Now if you get a question like this, now guys, I'll be honest with you, this is way easier. I don't know if you know the unit, right? If you know the unit, this question here is way easier than a second or a third unit question. Just direct as ever you can get a question. What is this? What is that? This and that. That is why I'm telling you, I've told you all before also, right? Pay very close attention to this unit, because this unit questions are easy as ever. Only in 2013 it got a little hard, but apart from that, every other year one small question can be a little hard, but everything else is very, very easy, very direct, right? Yes, you can talk about the profit of perfect company firm. You can say in the long run, they only earn normal profits. So you can say that also as a characteristic if needed. Okay. So anyone who did this, how much did you all get out of 20? Just roughly mark your answer. Nice. A lot of 20s, a lot of 19s. So anything above, let's say around 15 or 16 is a good mark, right? Even if you got 0, if you learned from it, it's a perfect, right? So second answer is this, law of diminishing returns. Okay. It's simply that they're asking you to explain for 2 marks. So this is more than enough. Okay. So that's that with the 2011 paper. We'll go on. If you write 4 characteristics with the explanation, is enough. In this year, you have to kind of explain the characteristics a bit in detail. You write the 4 types, state the 4 types, right? And the characteristics of one go a little bit in detail. Don't explain points. Don't write points. They're saying explain the distinguishing characteristics. So in a paragraph, put all the characteristics and write a paragraph. That's a better way to write that answer. Okay. Done. Then we go on to 2012. Okay, again, these are easy questions. Okay. What is meant by short run production function? What is meant by short run production function? What is the short run production function? Anyone? In the short run, your output. Okay, so I'll say short question number 1, right? The short run. If they ask you distinguish, can we table it? Don't table it. When they ask you distinguish, don't. If they ask you differentiate, then you put it on a table. But in your A levels, they will not ask you to differentiate. When they say distinguish, you write sentences, or maybe a say, you know, this is this, but this is this, or maybe in 2 paragraphs explain the difference. Don't put a table. Okay, unless they say differentiate. I have not seen differentiate kind of questions in your level. Okay, so what is meant by the short run production function? Okay, so okay, I'm getting good answers. The relationship between inputs and outputs. Okay, so give me a second. Short run production. Now see, it's just a 2 mark question. Don't write paragraphs and paragraphs. Short run production function. So you can say the short run production function is, okay, the relationship between inputs and outputs following the change in variable inputs. So the relationship, what is the production function showing? The production function is showing you the relationship, right? When input change, how is output changing, right? After you can say given the existing technology and capacity. Okay, so I'll make it simple. Relationship between inputs and outputs following the change in variable inputs while the technology and capacity of the firm. Now there is different ways of answering this question. Firm is held constant. So if you want, you can write the short run production function also. So how do we write the short run production function? Anyone? Q is a function, no? What? Q is output. So how do we write this? We can say Q output is a function of, right? So you can say L1, there is a lot of labor, right? L1, L2, let's say L3, or you can say V1, V2, V3, anything is fine. And you can go on until Ln, and you can say capital. There is only one K that is there, right? So capital is fixed. If you want, you can even put a line on top of this, right? So that is the short run production function. So in the short run, we are saying that the output, right, is a function of this output. Q is a function of the factors of labor and capital. Capital is fixed. So you can only increase your output by increasing the labor. Is it okay if we L1 and plus L2 so on? Yeah, that's perfectly fine. So it has to be L3, right? But make sure you put the K also though, because there is capital. You have capital, you at least have one fixed factor. So K is there. Don't just put LLL only, right? So if you write something like that, it is more than enough for 2 marks. So if they ask you what a production function is, so you can say Q is the output of, you can say it this way also. You can say Q, that is your output, is a function of labor and capital, but you have to say capital is constant. On top of capital, please draw a line. It has to be like that. not just L and K. Okay, even this thing this way is fine. Draw a line on top saying it is constant. That is what that line means. Isn't T included? Which T are we talking about? Not very sure about the T that you're talking about. Technology? No, you don't have to talk about technology. Technology is constant. That doesn't even come. You don't have to really say that. It's okay to say this, but you have to draw the line on top of it. It's okay to say output is a function of L and K, but you draw top of, because otherwise it's not short-run production function, it's just a production function. So they're not asking what is meant by production function. No. They're asking you what is meant by short-run production function. Yes, Ln means, it goes on and until infinity, L1, 2, 3, 4, 5, 5, 6, all the way to until Ln. Mathematically, how we write it, right? Okay, so you can write something like that. Okay, 2 marks. Then, okay, what is the law of diminishing returns? Right? They're again asking what is the law of diminishing returns. So you have to write the same thing that you wrote here, law of diminishing returns, for 2 marks. Okay, you write this. Now, see, same question. The very next year, they have repeated it. But now they have gone a little bit of addition to that, right? So what is the law of diminishing returns? So 2 marks, you write that. And what does it imply about the likely shape of the short-run cost curves? So you talk about the short-run cost curves, guys. How does the short-run cost curves look like? So I'll show you the short-run cost curves. Let me try to Google it up. Short-run cost curve. You can talk about the, this thing. Let me get copy an image and put it into this. Okay. So you write the definition for 2 marks, but same thing that we wrote in the previous question. Okay, this one. Okay. So what does it say about these short-run cost curves, guys? So can you, based on this, can you explain? You don't have to explain AFC. To explain, let's say, average cost and marginal cost, it's enough. And if you want, you can go in detail and explain. But this and this, you can explain if you want. So you can say, because of the law of diminishing marginal returns, initially, right, the average cost, average total cost, and marginal cost tends to fall, right? After a certain point, right? Or if you want, you can go in detail. What does it imply about the likely shape of the short-run cost? Or what you can do, another approach of answering this is you can talk about how does the product curves look like. Okay, so you can talk about, let's see, I think I had an image of the product curves that's it somewhere. Okay, yeah. Okay, so you can answer it this way also. So I'm repeating once again, how do you answer this question? Okay, which question are we in first? We are in 2012, question number 3, part 2. What is law of diminishing returns? You write the definition, what we did in the previous paper, this one, right? That is 2 marks. Then they're asking you, no, maybe 1 mark there. And then what does it imply about the likely shape of the short-run curves? To explain maybe the short-run curve, to explain these shapes, maybe you can talk about these curves. You can talk about the product. Law of diminishing marginal returns is talking about the product curves. It's saying after a certain point that the marginal cost, remember these curves we labeled, right, when we were doing the MCQs, this is marginal product, number 2, 1 is average product. You talk about that, you say, first talk about, they're asking about the cost curves only, but that's okay. You talk about the product curves first. You say initially the MP rises, right? After that, it starts to fall as more of variable input is added. And then, it cuts this curve and go all the way. And then you say that these short-run product curves are mirror images, or you can say the short-run cost curves are mirror images of the short-run product curves. So as long as when the marginal product is rising, right, when the MP is rising, you can say the marginal cost tends to fall. When the marginal product is falling, you say the marginal cost tends to rise. Then in addition to that, you can say the marginal product cuts the average product at the topmost point, while the marginal cost cuts the average variable cost at the bottommost point. So if you can, explain that story, right? Maybe you can draw the diagrams also and draw this diagram also and show that they will give the tell the examiner that you have a better understanding of what you're talking about. So you can say when this is at the maximum, when MP is at its maximum, MC is at its lowest, right? So things like that, showing that it is a mirror image of what you're talking about. Okay, so that is how you answer that question. So I'll move this price maker, price taker into a little down. Yeah. So when you're answering that question, right? So better approach, I think, is by going with these diagrams. So you show that it is a mirror image, right? I'm hoping you all know that it is a mirror image, right? Show that part and then draw your thing and write your answer. Okay, that is what you do. Okay, then look at the third question. It's a repeat of what was there last time. Last year, they asked you what is uh, direct cost and indirect cost. Now they're asking you accounting profit and economic profit. Because accounting profit and economic profit differs because of the cost that they take into consideration. So how do the concepts of economic profit and accounting profit and economic profit differ? What is the main difference? How do you explain that? Hmm? So you can start off by saying, right? You can start off by saying in economics, there are two types of cost, right? Direct cost, that is the cost of, purchasing inputs from outside parties. And there is indirect cost, that is the cost of using the firm's own uh, inputs. Then you say accountants, when calculating profit, take into consideration only the direct cost. So for an accountant, you can say, right? So you explain that story and then you can write the equation saying accounting profit equals, right? Now you all know these, accounting profit is equal to, right? The total revenue minus the direct cost, right? And then you say, however, right? However, in economics, right? In economics, the profit, right? So economic profit is equal to economic profit. Give a second. Economic profit is equal to the total revenue minus the direct cost and also the indirect cost. Or in other words, you can say the total opportunity cost. So that is the difference between economic profit and accounting profit. In addition to that, you can say in a situation when there is indirect cost in production, the accounting profit will be higher than economic profit. Now, accounting profit usually is high, not always high, because if indirect cost is zero, then accounting profit and economic profit are the same. So don't say it's always high. You can say in a situation where there is indirect cost in production, usually there is, right? When there is indirect cost in production, the accounting profit will be greater than the economic profit. Can you show the previous question diagram? Okay, so that is what you have to write. So you talk about the cost, then you go and talk about the profit that is there. Okay. So yeah, you can talk about the financial benefit and things like that. Fine. Okay. Yes, total revenue minus economic cost. You can write it that way also because accounting direct cost and indirect cost together is economic cost. Okay. Done. Okay. What is meant by price maker and price taker? So they give you 2 marks for writing what is a price maker, 2 marks for writing what is a price taker. That is how the marks will be allocated. So what is this price maker, price taker? Lazy to type, so I got it from the internet. Guys, remember you all can study so much of things from the internet, guys. You all don't even have to, let's say, have a complete note. You can just Google things and study. So there is no excuse saying, I didn't, let's say, have the money to go for a class, so I don't know this unit. Now only I started studying. Those are bullshit excuses. If you don't have, let's say, the cash to go for a class or something, get the teacher's guide. Obviously, you all have internet, no? You can Google something, no? Right? Google something, learn, guys. If there is a will, there is definitely a way, right? So there is no excuse. Now, you see, I remember last year, there were a lot of students coming towards the end and saying, yes, I did not have money. I understand. Yes, not everyone is in a very good financial situation. But if you really want it, guys, you can definitely get it done, right? If you really want to do it, right, it's not about the money. You can simply download the teacher's guide from the internet, right? You can Google these stuff, whatever that you don't understand. You can watch a video on YouTube, right? And you can still get it done, right? So don't, let's say, come up with those excuses towards the end saying, this is what that is stopping me, because that is not really a big barrier. Okay, so what is a price maker and a price taker? In very simple terms, opportunity cost equals explicit cost plus implicit cost. Why are we considering explicit cost and opportunity cost? Nice, good question. So remember, in economics, we say opportunity cost is direct cost and indirect cost. Now, why is that? Now, this both together we say is opportunity cost. Why only that part? Now, remember, even direct cost, let's say the money that you paid for, let's say some person outside, right? Let's say you paid electricity, let's say you paid wages, let's say you paid for your raw materials. Now, even that money that you paid, right? There could have been something else you could have done with that, no? Now, indirect cost, yes. Now, indirect cost, for example, foregone income. So, because you are doing this, you are letting go that. There is an opportunity cost. Same thing with the money you're spending, no? You're spending money on electricity, you're spending money on wages, you're spending money on, let's say, buying raw materials. With that same money, you could have done something else. So that even that money has an opportunity cost. That is why opportunity cost is the addition of direct cost and indirect cost. Okay, not just indirect. Okay. Okay, back to this price taker, price maker. Nice. So price taker, all of us know, right? Price taker is where the fellow come in. He comes in a perfectly competitive market. You can say in a situation of perfect competition, right? A firm is a price taker. What does that mean? That means, right? The firm can sell any amount of output that it has at the prevailing market price. It does not have the ability to set its own price. So you can go in detail. You can say, why is a firm in perfect competition a price maker? Sorry, a price taker. Why? Why is a firm now? If that was the question, what are the 3 points? Why is a firm in perfect competition? In a second. In perfect competition, a price taker. Why are they a price taker? Guys, for 3 reasons. Number one, they have a homogeneous product. Everyone is selling the same product, so you can't charge something else, right? And then one firm, right? One firm supplies only a small portion, right? A small portion of the total supply, right? So, or you can say there are a large number of suppliers, so is just a small portion. And also there is perfect information. Or the second point, you can say yes, insignificant market power and perfect information. So perfect information means everyone knows what is the actual price. So you can't charge now when you're selling a homogeneous product and you're just one small fellow in the entire market and everyone knows what is the price, everyone knows what are the other people selling everything. How can you charge a different price? You have to take the price that is there in the market. So that is what a price taker is, taking the price that is there in the market. Then who are price makers? Price makers, right, are the people who are able to influence the market price, right? They can charge whatever price that they want. Not, I'm not saying a very high price, very low price, but whatever price that they want, something reasonable, they have the power to charge it, right? So we say price makers are found in imperfectly competitive markets such as monopoly, oligopoly. Even monopolistic competition to some extent are price makers, right? So if you write that part, you get your question. Can they decide both price and quantity? No, monopoly firms can only decide one of the price or the quantity. I explained that in a MCQ. I'm hoping you all do remember that. That was there in one of the MCQ. Can a monopoly firm decide the price and quantity, price or quantity, price only, quantity only? Yeah. It was price or quantity. I explain why is it the price or quantity. Just refer to whatever note you made. Okay. Done with that. And then they're asking you what distinguishes oligopoly from monopolistic community. Please don't draw a table, right? They're not asking you differentiate oligopoly and monopoly, right? Answer like a A-level student, not like a O-level or a grade 5 student, right? I've seen this because I've marked a lot of papers. Every fellow is drawing a table. Don't draw tables, right? So you write it in sentences. So you can say in oligopoly, right, a few firm dominates the market, while in monopolistic competition, there are large number of firms. That is one point. Like that, you write around, let's say, 6 points, right? So you can say in oligopoly, there is a considerable amount of barriers to enter, while in monopolistic competition, there are not much of barriers. You can say oligopoly, let's say the firms are interdependent, right? In monopolistic, they are not. So you write sentences like that. Don't put it into a paragraph. Maybe 6 points, even 4 points would do, right? So on the safer side, since they're giving 6 marks here, maybe write 6 points. So talk about the product, talk about the barriers to entry, talk about, let's say, the amount of sellers in the market, talk about, let's say, what else can talk about? The amount of competition that is there, right? You can talk about different things. So even 4 is fine, right? You can go on. Yeah, you can talk about the demand curves. You can say oligopoly has a king demand curve. Okay. So distinguish between this and this in a sentence form. When they say distinguish, don't draw your table. Okay, do that. Yes, you can talk about profits, anything that they is there. So I'm not going to give you the points, guys, because I'm hoping you, by at this stage, at least you all know the features of what is oligopoly, what is monopoly, and you all know the features. People who don't know the features, start studying at least now. Yeah, high time that you get on board and start. Okay, so 2012 also done. I think this was a little bit harder than the 2011 paper. I think the only thing that is a little bit harder, I think this question, maybe you would not able to score the full mark. I'll just say a little uncommon, and maybe price taker in the price maker part, you would have not been able to score the full mark. Apart from that, everything else is very much easy. How much you get? All those who did 15 and above? Yes, 17, 14, 18, 14. So don't worry, right? It's the same question that they will ask over and over again, right? So whatever that you got wrong, you go through, right? You can do what you want. Second question, second question answer is in different forms. What is the law of diminishing returns? The first part, you start with this, you write this first, what you wrote in the previous one, and then you explain this diagram. I didn't type the explanation, I explained it only. This diagram you need to explain. Okay. So if you have not missed the answer, go to your past paper book, the answer is there behind. Okay. Okay, done. Then we go into 2013. Now this paper, in general, the 2013 paper is somewhat of, I'll say, the hardest A-level economics paper. Remember, like for accounting, I think it's 2011. That is the hardest paper. I can't remember which year. 2011, accounting. Which one was the hardest paper? 2011. I remember that was a kind of hard paper. 2011. For economics, similarly, the 2013 paper is a little hard. I'm not saying it's an impossible paper. It's compared to the other papers, it is a little hard, right? So, but I like the questions that is there in this, right? Now see, now again, they're talking about law of diminishing returns and law of returns to scale affect the firm's bottom line. Can you see that every year they have been building a little by little on this? Now see, law of diminishing returns. First they ask, what is law of diminishing returns? 2 marks. The next year, they ask, what is law of diminishing returns and what does it say about the short run cost curve? Now they're asking, what is law of diminishing returns and what does it say about the cost? plus what is law of returns to scale and what did it say about cost. So every year they've been adding a little by little. So if you know, if you have done your papers, it's a very easy thing, right? So explain how the law of diminishing returns and law of returns to scale affect a firm's cost of production. So what you have to write is the same story. You start with, right, what is law of diminishing returns, right? The first point. Then you say, you know, what happens to these product curves, right? The maximum marginal product marginal cost is at its minimum as variable input increases, MP diminishes, MC increases then, right? So you talk about the mirror image part, right? And then you say that part. So that is how the what short run cost curves are determined, what I explained in the previous question. The new part is this part. This is the new part. These 3 points are the new points that you have to add. Now they're asking you how the long run cost curves are determined based on the law of returns to scale. So you say in the long run, production is subjected to law of returns to scale, right? U shape of the long run average total cost is due to economies and diseconomies of scale, right? Remember long run average total cost, the curve looks like this. It comes like this, becomes a little constant and goes up like that, right? You have economies of scale, constant thing, and the diseconomies of scale, right? So you do that, you write that part. So economies of scale will result when increase in output lead to a decrease in unit cost. So this part is economies of scale, right? And then you have constant economies of scale, and then you have diseconomies of scale where the long run average cost. This is the long run average cost curve, right? Hoping you all know your diagrams. So that is what you have to write. Economies of scale, constant returns, and diseconomies of scale. So simple things. See, they have been building it up little by little. Right? Now, these questions are not hard if you have done your papers. Okay, so analyze the papers, guys. You can even predict what is going to come. You don't have to really draw the diagram, but if you want to, you can draw. Right? It's not a must to draw the diagram, but it's better if you can draw. I would recommend you, because it will not take that long now. I would recommend you to draw the diagrams, because it will say the examiner that you have a better understanding of what you're talking about. You have not like memorize something. You know what you're talking about. So that is what you can write for the first one. I didn't explain because I explained in detail earlier. Okay. And then look at this question. Now, this is a little tricky, right? Discuss whether there is a relationship between the marginal cost curve of the firm, right, and the supply curve of the industry. Now, you all know, right? Remember shutdown price and all of that. You know the marginal cost curve above the average variable cost. Marginal cost curve above the minimum average variable cost curve is the what? The marginal cost curve above the minimum average variable cost is the supply curve of what? Supply curve of the industry or supply curve of the firm? Okay, it's a supply curve of the firm. Now here, see, they're very tricky here. It's not supply curve of the industry. They're asking marginal cost of the firm and the supply curve of the industry. Is there a relationship? So what is the relationship between that? Right. So you all know the basics now. So I'll come into that part, right? So here, see, they say a perfectly competitive firm supplies the quantity, supplies the quantity that maximizes profits or minimizes loss. This is done by equating MR to MC, that you all know. Therefore, a firm's supply curve is the same as the marginal cost curve above minimum average variable cost. Remember, we said if you can't cover your minimum average variable cost, a firm will shut down. So only if you are getting a price above your minimum average variable cost, you will supply. So therefore, we say the firm's supply curve is the marginal cost curve above the minimum average variable cost. But they are not asking you this. They are asking you, does this marginal cost curve and the industry supply curve have a connection? Read it very carefully. They're not asking you the marginal cost curve and the firm supply curve. They're asking industry supply curve. So then I'm see how they've approached this answer. They're saying The industry supply curve shows the quantity supplied by the industry at each price when the plant size of each firm and the number of firms remain constant. The quantity supplied by the industry at a given price is the quantity supplied by all the firms in the industry, right? Hence, if we add all the marginal cost curves above minimum AVC of individual firms horizontally, we get the industry supply curve. That is the relationship. You all know that the marginal cost curve, above the, so if this is AVC, right? So if this is AVC, let's say the MC curve above the ABC curve is the firm supply curve. But what is the point here? They're not asking about the firm supply curve. They're asking you about the industry's supply curve. So what do you say? For the industry supply curve, it is the addition of all the firm's marginal cost curves. If you add all of them, you will get the industry's supply curve. Okay, so this has to be over this side. This is the firm. Okay, I'll just remove the parts, right? So make sure you answer the proper part and not what is not needed. They will understand that yes, no. If you know the MC curve is the supply curve above AVC for a firm, then you would have understood the industry part. If you are completely blank on that industry part, I know you all will not have understood, but at least if you knew the firm part, did you understand the industry part? Yes, no. Blank. Okay, so I'll explain it briefly once more, right? So here they are saying, explain, okay, now discuss whether there is a relationship between the marginal cost of the firm and the supply curve of the industry. Now, to understand this part, you first have to know there is a relationship between the marginal cost curve and the supply curve of a firm, right? Now that you should have that knowledge that there is something called a shutdown price, right? That firms, they minimum want to cover their average variable cost, right? Firms want to minimum cover that. So you have to know that relation. Then what I'm saying, to show the relationship between the industry, if you add all those marginal cost curves, okay, let me see if I have, okay, my tute will have the diagram. Give me a second. I expect you to have that knowledge, but never mind. Okay, give me a second. Let me check this in my tute. What you would have the color diagram. This one. Okay. So here, right, this red curve that is here. Can you see this red line? Look at the colors, right? See this red line, and can you see the AVC? This purple curve is the average variable cost. So we say in the short run, right, in perfect competition, a firm would at minimum want, right? They would minimum want to cover their minimum average variable cost. They have to get a price enough to cover this, because if they can't cover their minimum average variable cost, they will shut down and go, right? So therefore, this only if the price is above the minimum average variable cost, they will supply. So then we say that this curve, the marginal cost curve above the average variable cost curve, is also the short run individual firm's supply curve. A firm supply curve is equal to the marginal cost curve above the minimum average variable cost. That understanding you all should have had, right? And then they're asking you, they're not asking you the relationship between the marginal cost curve and the firm's short run supply curve. No. They're asking you the relationship between marginal cost curve and the industry supply curve. So what is the industry and what is the firm? The industry is the collection of firms, right? So the industry supply curve is going to be the total or the collection or the addition of all the marginal cost curves of each individual firm above the minimum average variable cost. That is what that answer is expecting. You need to have some sort of understanding to answer that, if not kind of blank. Okay. So go through, take some time and do study that, because if you're not studying, it's not gonna make sense. Okay. So that is what question number 2 is talking about. The relationship between the MC curve and the supply curve of the industry. I know it's a little bit of a tricky question, but it's a good question. Okay. Okay, answer of the previous question. What is the previous question? Law of diminishing returns. This? Oh. Okay, so you have that, and then the third question. Now, what is the third question? So can you please prove market supply curve? What do you mean prove market supply curve? Market supply curve is the addition of all the individual supply curves. So if the individual supply curve is the MC curve above ABC, the market supply curve is the all the MC curves above ABC. Let's just take some time and think about it, right? You should be able to understand. Okay. So 1 done, 2 done. The third one then, explain why a firm under perfect competition faces a horizontal demand curve while the industry faces a downward sloping demand curve. What is the reason for this? Why is the firm facing a horizontal demand curve or a perfectly elastic demand curve? Anyone? Why do we have? Exactly. Guys, the firm is facing a horizontal demand curve, right? Or a perfectly elastic demand curve is because they're a price taker. You have to highlight that, right? So in the third question, or same question, now in last year they asked you what is a price taker. Now they're asking you why is the firm having a perfectly elastic demand curve. They're having a perfectly elastic demand curve because they are a price taker. So you say that, right? You have a horizontal demand curve, right? I'll say horizontal demand curve due to the fact the firm is a price taker, right? And then you explain why the firm is a price taker. You write the 3 reasons that we explained before. Homogeneous, I'll just type in short form. You say homogeneous products. You say small player in the market, and also perfect information, right? You say that. So therefore, they can sell any amount of goods that they have at whatever price that is there. Okay, so I put the answer also. Nice. Okay, you go there. So perfect competition, firm is a price taker. So this follows that the fact that the product is homogeneous, tiny proportion, that you do all of that. That is what is that. So then we say the graphical expression of the demand curve of a firm which is a price taker is a horizontal straight line drawn at the going market price. So you all know how the individual firms demand curve look like. It looks like this. Why does it look like this? Because the firm is a price taker. Why they are a price taker? Because of these reasons. Okay, now this is a good question to do again. And then the industry demand curve. So industry demand curve is downward sloping. That is not perfectly elastic because the industry, the product of an individual firm is a perfect substitute product for another firm in the industry. Hence, demand is perfectly elastic. But the elasticity of a downward sloping demand curve depends on the substitutability of the particular product for other goods and services. Now, if you look at the industry, guys, if you look at the one single firm, what is the case? If it's one single firm, then other firm is a perfect substitute and all of that. So you are a price taker. But if you look at the industry, right? If you take the entire rice industry, right, then one rice farm, if you take the rice industry and let's say the other rice growers, let's say not sorry rice industry and let's say another product, let's say noodles or something like that. Now those are not perfect substitutes, so that will not become a price taker there. So there is some sort of power if you take the industry as a whole. So that is why the industry has a downward sloping demand curve while the firm has a horizontal demand. Industry has a downward sloping because the industry is not perfectly substitutable with something else. One firm's product and another firm's product are perfect substitutes, right? But this one industry and another industry are not perfect substitutes. So they don't have to have a horizontal demand So as such, they can have a downward slope in demand curve. That means they can charge the price that they want. What is this small player? A small player here means they are a small proportion of the entire market. There are a large number of sellers. They are just a one small party. Now this I explained the previous question. Yeah, when I explained price taker. Okay. So that is what you have to write in that. Now this is, I'll accept that this paper is a little bit harder. The other papers are kind of easy. But if you're at a level that you can answer these questions properly, that means you've kind of understood the unit very, very well. That's good news. Okay. Okay, done with 1, 2, and 3. Okay, question number 4. That's also an interesting question. I didn't get that point. Which point didn't you get? Okay, I'm not very sure which point you're talking about. Let me know. I'll explain. Okay, so question number 4, right? A firm operating in the short run reports that its total revenue is 100 million, right? Total revenue 100 million. Total cost is 120. Fixed cost is 40. Should the firm stay in the business and why? I'll come to the small play after this. So should the firm stay in the business? Yes or no? What does it depend on? How do you make that decision? Whether the firm should stay or not will depend on what? Okay, so question number 4, if you're answering that, so whether a firm should stay or not in the business will depend on whether they can cover their variable cost, right? So if the price is greater than average variable cost, or the total revenue should be more than the total variable cost, right? So you can say in question number 4, right? Yes, the firm is making a loss. Now you understand that the firm is making a loss. No, revenue is 100, total cost is 120. They're making a 20 million loss. But still, should they stay or not? Should they stay or not will depend on. Now see, I'll explain the story. If the business stays, right? If they stay, okay, their total cost is how much? Sorry, total revenue. Total revenue is how much? 120 million, right? Total cost is how much? Cost is 100 million, right? Total cost is 100 million. Total revenue, total revenue is 100. Total cost is 120, right? So total cost is 120 million. So what is the loss that they are making? If they stay in production and if they do all of this, they're making a loss of 20 million. So loss is 20 million. Loss of 20 million. Now see if they shut down. Now, first of all, you have to understand what is the meaning of shutdown. Guys, shutdown does not mean you completely stop production. Shutdown means, now for example, if you look at hotels, right? Now there are some hotels, they are closed during the, let's say, off-peak seasons. And they only open, let's say, in April, December, something like that. That is what shutdown means. Shutdown does not mean you completely close everything and go. Shutdown means you are temporarily closed. So remember, even when you shut down, you have to incur the fixed cost. It's closed only for a certain period. Your rent, let's say your insurance, things like that, you have to pay even if you shut down. So think when the firm shuts down, right? If they shut down, what will be the total revenue? Think if the firm shuts down, total revenue. Total revenue is zero, right? Now they're not earning anything. But what is their total cost? Total cost if they shut down. If they shut down, remember, they still have to incur their fixed cost, guys. The rent and everything they have to incur because they are still in that place, right? So if you look at this example, they're saying no, total fixed cost is 40 million. So they have to incur the 40 million worth of fixed cost. So now, can you tell me their loss if they shut down? If they shut down, their loss is how much? They're earning nothing. Their fixed cost is 40 million. So they are making a loss of 40 million if they shut down. So where is their loss is minimized? If they stay or if they shut down? What is better for them? It's better to stay, no? If you stay, you're only making a 20 million loss. If you shut down, you're making a 40 million loss. So it's better to stay. That story is what you have to explain here. You can put numbers and you can explain this. The firm operates shutdown. Should they stay in the business? The answer should be yes, they should stay. Why? You should say that their total revenue is at least enough to cover their variable cost. No, their variable cost is how much here in this example? Think a little. How much is their variable cost? Total variable cost is exactly total variable cost is 80 million. So their revenue is 100 million. They're at least getting are able to cover their variable cost. So they should stay there. If a firm can at least cover their variable cost, they have to stay. So here this firm is actually covering the variable cost. So I calculated a loss. It's only 20 million. I also calculate if they shut down. So if they shut, now remember, shutdown does not mean you completely close the business. Shutdown means it's a temporary stop, right? You don't produce. Even temporarily, if you stop, you have to incur your fixed cost. So revenue will be zero, but the total cost will be still 40 million. They have to incur their fixed cost. So the loss will be 40 million there. So it's better to make a loss of 20 million than making a loss of 40 million. That is why we are saying it's better to stay in the business. That is the answer there. Okay. Okay. Final question. Why is the equality, right, of MR, marginal revenue, and marginal cost essential for profit maximization in all market structures? Now, that is usually a 4-mark question. But here, since this paper is hard, in addition to that, they have asked something else also. They have asked you, explain why price can be substituted for marginal revenue in the MR equals MC rule when a firm is operating in a perfectly competitive industry. Let's break it down first. Let's answer the first part of this question up to here. Let's answer this part, right? Why is the equality of MR equal MC? Why do we say MR equals MC is the profit maximizing output? I'm hoping you all know the logic behind that. Why MR equals MC is the profit maximizing? Think. I'll show you the diagram. Okay. So if you're calculating MR equals MC, right, that is this point, right? We are saying this point is the profit maximizing point. This is why they have, this is the amount of output that they have to produce. But why is that? What is the reason behind that? Think at any level of output below this, at below MR equals MC, at this point, right? At this point, what is the thing? Now see, this blue line here is MR. This orange curve that is going is MC. So at this level, MR is greater than MC. You agree there? At this part, MR is greater than MC. Now, what is MR? What is MC? Logically understand. MR is marginal revenue. That is the additional revenue that you earn per unit. For example, per unit when you sell, you're earning an additional revenue, let's say of 50 rupees, right? But here, the MC, the marginal cost to produce that additional unit, let's say it only costs you 30 rupees. So it's good for you now. Why is MR greater than MC, not the profit maximizing output? Now, this is good now. When at this level, now MR equals MC, not real, no real profit. Now, the marginal revenue is also 50, marginal cost is also 50. But here at this below level, right, you can earn a profit now. Logically think. So you have a marginal revenue of 50, your marginal cost is only, let's say 30. You're making every additional unit, you're making a profit of 20. So why is MR greater than MC, not the profit maximizing output? Anyone? No one? MC is falling, not because MC is falling. highest distance between TR and TC profit maximizing output can be shown where MR equals MC. MR is okay, that is fine. But why? I'm asking the logic behind it. Why is MR greater than MC, not the profit maximizing? No, it's good. No, now you all understand it's good. No, MR means the marginal revenue, the additional revenue of producing it, of selling each unit. I'm saying it's 50. The marginal cost I'm saying, let's say it's a lesser amount, it's 30. So that is actually good. No, you're earning each additional unit, your revenue is more than your cost. So why is that not the profit maximizing level? Why is MR equals MC the profit maximizing level? What is here? No, not because MC is minimum, not because MC is sloping downwards also. Guys, think logically. Here in this situation, right? I'm sad to see that no one has really got the understanding behind it, but I think I explained this clearly in my revision class. I'm not very sure if anyone is there. Guys, the logic behind here is, right? We are looking at profit maximizing, right? So here at each different, now listen to me very carefully here, right? At each of these, at any of this part, right? At any of this level, right? Each additional unit, right, is giving you profit. No. So MR greater than MC means each additional unit is giving a positive profit. No? So when the MR is 50 and the MC is 30, each additional unit is giving you a 20 rupee profit. So is giving, let's say, a positive profit. So therefore, if you want to maximize this profit, if you want to increase this profit, what should you do? Each additional unit is giving you more and more profit. So if you want to increase the profit that you're making, if you want to maximize that profit that you're making, you have to increase output. Look at this stage, at this part, where MC, right, here at this point, at that level, the MC is greater, right? Give me a second. Okay. Right. Why is this stuck? Okay, wait. This is stuck. Okay, so look at this level of output here. At that level of output, the marginal cost is greater than the marginal revenue. Here, right, when the marginal cost is greater than marginal revenue, each additional unit, the cost is more than the revenue that you're making. So if you want to maximize your profit, then you have to reduce your output. If you're at this level is good. MR greater than MC is good. But to maximize, each additional unit is bringing more and more profit. So to maximize the profit, to get the best out of it, you have to keep on increasing the output. So the point where MR equals MC, now you have got the highest profit that is possible. Even let's say in a small amount here, let's say a little less than that, and still the MR is greater than MC. Still you're making a 10 rupee profit. So you have to increase your output even more until the marginal revenue equals the marginal cost. That is why MR equals MC is the profit maximizing point. Yes, MR greater than MC is adding to the profit. So to maximize it, you have to keep on increasing your output. When MC is greater, when the marginal cost is greater than marginal revenue, you have to decrease your output, right? So that is the logic why MR equals MC is the profit maximizing level of output. If you are not sure, please go and study. That is a very tested area, right? So if you look at this, they are talking about if marginal revenue exceed marginal cost, that is the first part of the diagram, right? Then the extra revenue from selling one more unit exceeds the extra cost incurred to produce it. That is what I said. Extra revenue is 50, extra cost is, let's say, 30. So the firm makes an economic profit on a marginal unit. So each additional unit, they make a profit. So to maximize this profit, to increase this profit, so its economic profit increases if output is there. To find the profit maximizing level, you have to increase the output. If MR is less than MC, right, then each additional thing brings a loss, right? So therefore, you have to decrease output. In the situation where MR is equal to MC, whatever profit is maximized. So that is the first part of your answer. Revision students, if you can't remember the logic behind it, please go watch the recording for unit number 4. Unit number 4, where I explained this part. I went very much in basic and explained that part if you have forgotten. Okay, make use of that recording. Okay, then there is a second part of this question, right? See, now if it was a normal paper, they would have just given you that part and given you 4 marks. But this is a 2013 paper, somewhat of a hard paper. They've gone a bit more in detail. Instead of stopping there, they're asking, explain why. Okay, what is meant by small player? Did you understand this part when I said this? Price taker. Why is a firm a price taker? One firm supplies only a small portion of the total supply. Yes or no? Got it. So if one firm is supplying only a small portion of the total supply, means he's a very small player in the market. No, player means a small part of the market. That is what I'm saying. So instead of writing this long thing, I just said small player. Okay. Since he's giving only a very small portion of the total market supply, is a very small player in the market. He's not a dominant player in the market. Okay, that is what that meant. Okay. Okay, this part. So this part is saying, explain why P can be substituted for marginal revenue in the MR equals MC rule. So even this I explained in my revision class. Remember I said in perfect competition, the price, the marginal revenue, the average revenue, all of it is equal to each other. Yes, in perfect competition. So why is that? That is because firms are price takers, guys. They can sell any amount, right? They can't charge whatever price they want. They can sell any amount at the prevailing market price. So the additional, now see, every time, right? Let's say they are, they're selling number of units, right? So let's say the price, let's say the total revenue, and let's say the marginal revenue, right? The marginal revenue is the additional revenue of each unit. So I'll just give numbers here, right? So let's say they're selling 1 unit, price is let's say 50. So total revenue will be 50, 1 into 50, right? Let's say they're selling 2 units, the price is still per unit is 50. So total revenue now is 100. Let's say they're selling 3 units, price 50, total revenue 150. Let's say they're selling 4 units, 50 and 200. So now calculate marginal revenue and see. What is marginal revenue? Marginal revenue is the total change in total revenue divided by change in number of units. So if you go from here to here, right, change in total revenue is 50, change in number of units is 1, 50 divided by 1 is again 50, right? From here to here, again 50. From here to here is again 50. So in perfect competition, the price and the marginal revenue, even the average revenue is equal. It's equal because the firm can't change the price. No, every unit that they sell, every additional unit that they sell, they have to keep charging the same price because they have a perfectly elastic demand curve. No matter how much they sell, the price is 50. So that means each additional unit that they are selling also, the revenue that they are getting is also only 50. So that is why price can be substituted to marginal revenue in perfect competition. Yeah. So this question is actually a very good question. This all 5 parts are equally kind of hard. I don't see a very easy part in any of this. How did you do this? How many marks? It is, I feel bad for the people who wrote this paper also, 2013. This is a kind of hard paper, but if you can, right, if anyone is at the level of, answering this properly, if you can answer this paper properly, okay, your brother did it, tell him I said very sorry for him. So in case, right, if you can answer this question properly, that means you properly understood the unit, you've understood the basics to the advanced part of that unit. So how many you'll get? Okay, there's one with 15, others no, didn't even try, left it blank. 12. It was hard. Yes, it is hard. I totally agree that this question is hard. And even my mouth kind of hurts. And I know that what I explained would have not made any sense if you don't know the basics. My explanation would have been utter Greek if you did not know the basics. Which part do you want me to show? Third part. So there is one with 17 also. Nice. This one. Hey, these are answers I got from the past paper book because I was lazy to type. Because I put all the answers because I know you all don't know what to write. Okay, shape. Was there any explain the first part of question 5? Guys, first part of question 5 is that's a basic part. Why MR equals MC is the profit maximizing level. Just check on any note that you have. That is definitely there. Why MR equals MC is the profit maximizing. I was with the understanding that you have some knowledge and I just recapped that part. Okay. This why MR equals MC is the profit maximizing. So then this part, then why can price be substituted to marginal revenue? That is the second part. No, that is because in perfect competition, guys, a firm is a price taker. So they can sell any amount that they have at the prevailing price. So this is how the demand curve is. No, so any amount they have, they can sell at the price of 50. So every time they sell an additional unit, right, the additional revenue is also 50. So the price is also 50. The additional revenue that they earn is also 50. That is why price and marginal revenue can be substituted instead of each other. But if you look at, let's say if a firm has a downward sloping demand curve, you can't say price equals marginal revenue. Because let's say if this was the price, let's say price was 10, the firm was selling 100 units, right? So let's say to sell 101 units, right? So let's say price has to fall down to, let's say 9, let's say 110. So you can calculate marginal revenue, get the total revenue, get the change in total revenue, get the change in units, right? You can calculate, but it will not be the same. But in perfect competition, since you have a perfectly elastic demand curve, the price and the marginal revenue will be the same. So that is what that part is. Check whatever tute that you have, it will definitely be there. Revision class students, your revision tute has it, your recording has it. Please go watch if you have forgotten. Okay. So that's a hard paper. So what you should do with this hard paper, not avoid it, go through, take some time. If you have not done these questions, right, take some time, study the unit, right, learn from these questions, see what is this, understand every bit of the answer, Google things, watch videos, do whatever, right? Because I'm telling you, if you can answer these questions, the other questions are easy, right? It will be easy. So good part to do. Yeah. Okay, so you know the good news, because of this paper was very, very hard, next year they did not test this question. Since the 2013 paper had a very hard this part, right? They did not test this in the 2014 paper. Yes, I'll teach this part in the 2022 theory. 22 theory, 21 revision class students. I've told you all, if you all want, you all can come for the 2022 theory class for free. But if you want the tute, you have to pay the cost for the tute, not the monthly fee. But you will not get the recording. You're learning for free, so come and learn it. Make that effort and come on Thursday night, 7 to 9, and you learn it and go. I'm not going to give you the record because then I felt a lot of people are taking it for granted. Right? So recording will not be there. If you want, you come and learn. I will be teaching this again for the 2022 part, but not right now. It will at least in the 4th unit. It will take some time to come to that part. So it's up to you. If you really want to, you can. There is enough and more opportunities that I've created. If you really want to learn this, make use of it if you want. Okay, so 2013, this was the paper. Good news, 2014 did not have a question, right? So see now 2014, right, they didn't put a second part question, but what did they do? They increased the amount of MCQs. See, MCQs, there were a lot of MCQs in the 2014 paper from this unit, but they didn't put a second part question because it was kind of blank. So if you are a revision class student and you want to get added to the 2022 group, drop me a text. You can come for the class for free. If you want the tutor, you have to pay the 250 fee. Message, but I didn't reply. Just drop me a text again because I might have been a bit busy. If you are one, I will add you. Yeah, Thursday 7 to 9. You come, you can learn it, but you will not get the recording. Okay. So recordings, if you want, you have your revision class recordings. You can watch that. Even in that, I have explained in detail. Okay, kind of tired also now. Okay, so 2015. Okay, now this question is one of the easiest questions now that has come again. Okay, question 1, repeated. Not going to explain that, guys. Distinguish between explicit and implicit cost. Same answer, what you did before. Name 4 types of market structures. Repeated question. Come on, if you don't know 4 types of market structures, don't write this time A levels. Stay 1 year and write next year. Okay. If you don't know the 4 types of market structures, perfect competition, oligopoly, monopolistic, and monopoly. Right? That there. Not going to explain these 2. What is the rule of profit maximization? Right? Same question that is there in the 2013 paper. They've worded it differently. 2013 question paper, they're asking you why is MR equals MC the profit maximizing thing, and why can P be substituted, price be substituted when it's a perfectly competitive industry. Same question, right? See how they worded it. They're saying what is the rule of profit maximization, right? What is the rule of profit maximization? And right, I'll come back to the things. I'm just eliminating the common questions, right? So what is the rule of profit maximization? The MR equals MC. You have to explain the MR equals MC story. Same 2013 answer you can write. And how can this rule be restated when the firm is a price taker? That means when the firm is a what? Perfectly competitive firm. So when a firm is a perfect competitive firm, MR equals MC. Without doing MR equals MC, you can say price equals marginal cost. So it can be restated saying P equals MC. Same thing in the 2013 question. Yes, 2022 class, guys, only the revision class students can come, not anyone else. Because it's not fair, no, guys, because otherwise other students are paying and coming, and if I let anyone else free. Yeah. I didn't go through the 2014 question, guys. I didn't go through the 2014 question because there is no 2014 question. I told that, right? I'm hoping y'all are in this world. Yeah, and not in some other world. I clearly told 2013 question was hard, so 2014 did not have a essay question on this unit. Guys, please be in this world. Yeah. Don't ask me what happened in the 2014 question. Have we started Unit 9 in the revision class? No. Unit 8 is finishing today. Unit 9 is starting next week. Yes, no 2014 question. If there was a question, I would have put it, guys. What is going on the 2022 batch? 2022 batch, I am doing unit number 4, this unit. So I've done 2 classes with them. So if you are a 21 student, 21 revision student, paid revision student, you can come for the 2022 class for free. I've told that before, but I'm not giving recordings because you all take it for granted. If you really want to learn it, come for the class Thursday, 7 to 9 p.m. and learn it. Okay. Drop me a text. I'll add you to the 2022 group. You can get the link from that. Okay. So these 3 questions are not explaining. Same question that was there, guys, right? So now you see that it's the same question repeated now. Okay, if you have learned from your previous questions, these questions are nothing. Okay, so I'll explain the question that is not there, the unhighlighted ones. Okay, question number 2. Why do economists regard normal profit as a cost? Why is normal profit a cost? First of all, what is normal profit? What is normal profit? This is a very common question, guys, normal profit. What is normal profit? Normal profit? Okay, TR equals TC, that's fine. But when you're talking about the cost aspect, how are you defining normal profit? Normal profit? Don't think about the TR equals TC part, not the zero economic profit part. Under indirect cost, we have normal profits. What does that mean? So normal profit, right, is the minimum profit, right, is the minimum profit, right, minimum profit expected by the entrepreneur for his skill, right? So for whatever thing that he does, right, the minimum profit that he expects to engage in the production activity is called the the minimum return the entrepreneur expects, right, to stay in the production activity. Now, for example, let's say I'm an entrepreneur, just example, right? I'm an entrepreneur. Let's say I have started my own business, right? So let's say because I am doing this business, right, I'm using all my skills, my time, right, my energy, all of that I'm using. So in my mind, I will have, right, a minimum return that I would expect. I would say I'm putting this much of my time, this much of my effort. I studied this much. I'm using those skills. So I am saying minimum I want 30,000 a month. So that is what we call normal profit. So if I don't get that minimum 30,000, I will switch into some other thing. I will not be continuing and producing this. I will produce something else. So therefore, in economics, right, why is this a cost now? So the business has to make sure that the entrepreneur, right, or the owner at least gets this 30,000, because that is why it's a cost. It's a cost because, right, the business has to make sure the entrepreneur minimum gets that 30,000 worth of money. Because if he does not, now 30,000 is in my example, don't ask where that came. Minimum he has to get that 30,000, because otherwise he will shift to something else. The entire business is gone. So that cost has to be met. Only if that 30,000 return is given to that entrepreneur, he would stay in this production activity. So the minimum return that the entrepreneur expects, right, for his skills, right, to stay in the same exact production activity. Otherwise, he would switch to something else, right? That is why what normal profit is, and that is why it is a cost. That is the story that you have to write there. Check whatever your that you have. There is a note that would be there. Okay, done. Questions? No, so this is also done. Okay, question number 5. Nice question. It's an easy question. Okay, they're saying, suppose a price taking firm. Now, price taking firm, what are they indirectly saying us? What kind of firm is this? A perfectly competitive firm, right? In a given short period, produces 20 units of output. Yeah, they're producing 20 units. The market price of the output is 50. So price is 50. At 20 units of output, average total cost equals 60 and average variable cost equals 40. How much profit or loss does this firm make in the given short period? Guys, how do you find profit or loss? You calculate the total revenue, you calculate the total cost, and revenue minus cost. So how much is the total revenue? Can you all give me answers? Total revenue, how much is the firm making? Price of the unit is 50. Sorry, yeah, price is 50. How many units are they selling? They're selling 20 units. So total revenue of this firm is how much? 1,000. Easy as ever. How much is the total cost of this firm? What is the average cost? Average cost they are saying is rupees 60. That means average cost means cost per unit. How many units are they producing? 20. So total cost is how much? Total cost is 1,200. Revenue is 1,000. Cost is 1,200. How much is the profit or the loss? They are making a loss of how much? They are making a loss of 200. So loss rupees 200. Explain the fourth question again. I didn't explain the fourth question. The same explanation that was there in the previous question. That is why I didn't explain. So guys, you have to understand that this 2015 fourth question and the 2013 fifth question. Wait a second. And the 2013 fifth question is the same thing. Why is MRA as a profit maximizing? They are asking, in the other question, they're asking what is the profit maximizing? And they are asking how can profit, explain why can profit be substituted, price be substituted for MR when the firm is a perfectly competitive industry. Here they are same thing, they're asking a different way. They're asking How can the rule be restated when the firm is a price taker? So same thing you have to write. That is why I need to explain the fourth part. Okay, because I explained it before. So loss of 200, that is the first part, that is part A. Okay, so 5, this is part A. Okay, part B. How much is the total fixed cost of the firm? Nice. Total fixed cost. Easy question, right? I don't think you'll get questions as easy as this. So part B, the total cost is equal to total fixed cost plus total variable cost for those who don't know the method, right? So total cost we calculated is 1200. Total fixed cost we don't know, we have to find. Total variable cost we don't know, but they have said average variable cost is 40. They are producing 20 number of units, right? So 40 into 20 is the total variable cost. So then 1200 minus 40 into 20 is 800, right? Is equal to the total fixed cost. Come on. Total fixed cost is equal to 400. So basic calculations like that you should be able to do by now. Okay. Now this paper was a very easy paper. This question, I'll say the only hard question would have been the fourth question, the part 2. If you have not done the 2013 question, but if you have done the 2013 question, this question part 2 is also not at all hard. Fine. Yes. Step questions. Yeah. It's now the same question getting repeated, right? Now, latest what they have done is they have changed the question a bit. They have given examples of cost and asked different things. I'll show you how that happens. Okay, 15 done. 16. Okay, I'm not going to explain this. First question, difference between diminishing returns and decreasing returns to scale. Diminishing returns, short run, you explain what the law of diminishing returns is. Decreasing returns to scale, okay, sorry. Diminishing returns, what is diminishing returns? Diminishing returns happens in the short run. It's the second stage of the law of diminishing returns. Remember law of diminishing returns? Remember the 3 stages in the law of diminishing returns? Yeah, hope you all remember those. The stages, law of diminishing returns. So in the second stage, what is happening? Can you all give me features of the second stage, law of diminishing returns? Stage 2, you know, first one is increasing returns, increasing margin returns. Then you have diminishing margin returns. Then you have negative returns. Okay. What is total cost? There is no cost here, no? Okay, so diminishing margin returns, what are the features, right? What is happening in total product? Total product is increasing, right? Total product is increasing at a decreasing rate. Okay, number 1. What is happening to marginal product? MP is falling, right? You can say even AP is falling, right? So then what is decreasing returns to scale? Decreasing returns to scale, you say it's a long run concept. Yeah, so you can give the reasons also. Why is this happening? This is because the fixed factor is fully utilized. That reason you can give. Okay. And then, okay, what is decreasing returns to scale? This is the long run concept. Long run concept. What does decreasing returns to scale mean? Decreasing returns to scale is where the long run average cost increases because of, okay, so decreasing returns scale. Okay, so, okay, not long run cost. You can say a proportionate increase, right? Proportionate increase, let's say in inputs lead to a what? Lead to a lesser increase in the output, right? So when input increases, output increases by a lesser proportion, remember? And because of that, what happens? The long run average cost tends to increase. So that concept, if you can write, you will get your mark. They're simply asking you to define now, right? They're simply given you two stages of different questions and they're asking you to Define that. If you know your stages, it's a very, very, very easy concept. Okay, done. Question number 3. Explain the relationship between marginal cost and average total cost. So what is the relationship between marginal cost and average total cost? 4 marks. So you can draw the diagrams also. Like you might get a mark for that. So MC, the Nike, average total cost, right? So what is the relationship between these two? Can you all tell me what is the relationship? Okay, one, MC intersects ATC at the bottommost point. Okay, that is one point that you can write. Fine. MC intersects AC at the bottommost point. Okay, what else can you write? So can you see at the first part? In the first part here, right? So let's say this is the first part. So let's say this is part 1, right? Section number 1. So in section number 1, you all know this is the MC curve. This is the average total cost curve, right? So when the marginal cost curve is below the average cost, look at it, right? In section number 1, when the marginal cost curve is less than the average total cost curve, what is happening to the average total cost? The average total cost is decreasing. So when you can say point number 1, whenever MC is less than ATC, ATC is falling. What is point number 2? So then you can say MC intersects ATC at the bottommost point, and after that you can say whenever MC, right? Whenever the marginal cost is higher than the average total cost, is above the average total cost, the average total cost is rising. That is the relationship. When MC is greater than ATC, ATC is rising. So when ATC reaches its minimum point, MC equals ATC. So on top of that, you can say maybe here you can say marginal cost is rising at a higher rate than the average cost. Here you can say marginal cost is, let's say, falling at a higher rate than the average cost. Maybe you can extend that, but your main point has to be when MC is less than ATC, ATC is falling. When MC is greater than ATC, ATC is, or AC is increasing. That has to be your main point. You can even draw the diagram for this to explain that relationship. Fine. Yes, no. Between marginal cost, average total cost. Yeah, you write that. Can you tell it again to write? Guys, to write, you have to write this. What is there here? So get a screenshot. Okay. Okay. So then question number 3. Now this is an interesting question. A little bit of a newer question. Explain the concept of, now this type of questions now come in papers, right? Concept of producer surplus, economic profit, economic rent. Remember, you don't have to explain. They're not asking you to differentiate. They're not asking you to do anything. They just ask you to explain the concept. So how do you start? You first start explaining what is producer surplus. Then you explain what is economic profit. Then you explain what is economic rent. You don't have to go and show connection of this and that, and not needed. They are not asking you to differentiate. They're not asking you to show similarities between this and that. Nothing there. So you start with what producer surplus is. Now this comes from unit number 2, right? So what is producer surplus? Producer surplus. Okay. Producer surplus. The surplus is what? We can say the surplus enjoyed by the producers, right? Because remember where there is an equilibrium price, and because of this equilibrium price, they are able to get a higher price than what they actually want. That is why there is a producer surplus. Yeah. So producer surplus, you can say surplus enjoyed by the producers, right? Which is above, okay, producers due to an equilibrium price, you do an equilibrium price in the market which is above the minimum price expected by the producer. So what is the logic behind that? Again, I've explained the logic behind producer surplus like 100 times now, but if you want, you can draw the diagram also, right? So you say there is this, let's say there is an equilibrium price, right? So they are willing to supply it at a very low price, but because of equilibrium, they get a higher price. So this difference becomes producer surplus, right? So the difference between the equilibrium price and the minimum price that the supplier expects is the producer surplus. Okay, so you can write that. Then what is economic profit? You go one by one. Now you don't have to connect these, right? What is economic profit now? So economic profit, you can say, is where, right, when the total revenue, right? Economic profit is where, what is economic profit? Economic profit is where, right, when the total revenue is greater than the total cost. So when you have when you're earning a revenue greater than your total cost, we call it an economic profit. So then you can say total cost is a combination of both direct cost and indirect cost. So if you're earning something above this total cost, then you're earning an economic profit. So you write that in words, you explain that, you again get a mark there. Okay. Then they're asking you, what is economic rent? What is economic rent? Anyone? Remember factor earnings? Anyone? No one remember factor earnings? Remember when there is a factor of production, right? We have the demand, we have the supply, and let's say we have the equilibrium wage. Remember this part is economic rent. Price paid to retain the labor is transfer earnings, guys, right? Economic rent is what the employee gets, right, in addition to the minimum that he expects. The minimum he expects, remember this part, I'm hoping you all know, this part is economic rent. That is the minimum he expects. So anything that he earns in addition, remember this entire box is the total earnings. So anything that he earns in addition to his transfer payments is called economic rent. So the, let's say income earned, give me a second, the income earned by a factor of production. So it can be labor, factor of production, above the minimum amount expected. So anything that he is earning above the minimum amount he expects is the transfer earnings. So if he is earning anything above that minimum amount, we call it economic rent. It is there in my unit 4 tute at the very, very end. Revision class students, if you all are not sure where this part is, it's there at the end, economic rent. Last part before the questions, if I'm not mistaken. Can we show this by using the elasticers? Yeah, you can show different types of elasticities, how is this changing and all of that. If you want, you can show that as well. Okay, so that question is done. Okay, so you get 4 marks for that, for properly showing those 3. Okay. Then why will a firm in perfect competitive industry choose why will a firm in a perfect industry choose not to charge a price either above or below the market price? Why didn't you say students to unmute and answer? The only reason I say students to unmute and answer, because if they unmute, they forget to mute. So I have to keep muting them 100 times. And then what happens is, again, the recording is a little messed up. So because I give you all the recordings in a proper organized manner only, I don't let students unmute, because you know, when you're listening to the recording, you can't focus. A fellow will jump in the middle and, you know, all of that is there. That is why I don't let. Otherwise, I won't mind you all unmuting and speaking at all. Okay. Right. Question number 4. Why will a firm in a perfectly competitive industry choose not to charge a price either above or below the market price? First of all, can they charge a price above the market price? Yes or no? They can't. They're a price taker. They're selling the same good that everyone else is selling, right? They're a small player in the entire market. Everyone has perfect information. So they don't have the power to charge a price above the market price. That has to be clear. You should say that these firms are price takers, right? So I've got something from the internet. They're saying radish growers. Now, radish is, you know, this thing, what do you call, what is radish? There's a vegetable, right? I can't remember the name exactly, right? So perfect competitive firms have no reason. Okay, so one, they can't charge a price higher because they are price takers, right? They don't have the ability to charge a price higher because everyone is selling the same price, right? They can't determine their price. They can't determine their own price. They have to take the market price. So they're asking, why is a firm under perfect competition, right? Why will a firm in perfect competitive industry choose not to charge a price either above or below? Why don't they charge above? Because they don't have the ability to charge above. They can't charge a price that is above above the market price because they're a price taker. They're selling the same product. Everyone has perfect information. If you charge a price above, no one is going to come and buy from you, right? And why will they not charge a price below? Exactly, because there is no use. Everyone is selling the same price, same good, right? If everyone is selling it at 50, why on earth would you go and sell it at 40? It's the same thing, no? No matter whether you sell 40 or 50, still people are going to come and buy from you guys, right? So there is no point you selling it at 40 because you know in perfect competition that this is the demand curve. No? Demand curve, I'll show you. The demand curve is perfectly elastic. Just because you give it at a lower price does not mean your demand is going to increase. At this price of, let's say, 50, you can sell whatever you want. So you don't really have to reduce it to 40 to sell more. Let's say you want to sell, let's say, a higher quantity, you still can give it at 50. You don't have to reduce the price. So there is no need for them to reduce the price. That is why they don't reduce the price. They don't sell below the market price. They don't sell above the market price. They can't, right? They're a price taker. They don't have the ability to do that because everyone has perfect information. Everyone is doing the same thing. Why do they not charge below the market price? There is no use of charging it because they can charge the market price. Even at the market price, they can sell whatever quantity that they have. So you don't have to reduce the market price to sell the quantity. Just because you reduce the price does not mean your demand is going to increase. People are going to buy the same amount. So why are you going to reduce it and give? You give it at the same amount. So that is what this that radish example says. So they say radish growers and perfectly competitive firms in general have no reason to charge a price below than the market price because no use. No. You can sell everything at the market price. Why are you charging a price below? No point. So they won't charge the price below because buyers have complete information and because we assume each firm's products is identical to that of its rivals, firms are unable to charge a price higher. Below there is no use, higher they won't because there is no point. So for perfectly competitive firms, they say price is very much like the weather, right? They may complain about it. You might say the price is too low, price is too high, but in perfect competition, there is nothing any of them can do about it. You might complain about the price. You can say it's too low and this and that, but you don't have the power to do anything, just like the weather. Yeah, that is what it says. Fine. Yes. Last question for the day. Can we say that because they have perfectly elastic demand curve, a small change in price will have a huge impact in quantity? You don't really have to go to that path there. You can just say, even at the price of 50 or even at the market price, they could have sold any quantity they have. So there is no need for them to reduce the price to sell any higher quantity. And that is why they don't charge any price lower. Okay, easy question. Following diagram Calculate the profit earned by the firm at the market price of 160. Remember, I did this over and over again in the revision class. First of all, what is the first step? You find where MR equals MC. Where is MR equals MC in this? Diagram shows demand curve and the firm operating from industry in the short run. Profit earned by the firm at the market price of 160. So MR is 160. So here, guys, this is the MR curve, guys. Right? Remember, price is equal to MR. So price is 160. This is the MR curve. So if this is the MR curve, where is MR equals MC? This. So what is the profit maximizing output? 40 units. Right? So first you find out where MR equals MC. They will not directly give you MR. They will tell the price. So price that is 160. You know price is equal to MR. So you go to that point, right? You find the quantity. And now can you calculate the profit? What is the total revenue at this stage? They're earning a price of 160. They're selling 40 units. So the total revenue is equal to how much? Yeah. So total revenue, you can say TR is equal to 160 multiplied by 40. That is equal to rupees 6,400. What is the total cost? Total cost. So at that level of output, find the average cost. So at 40 units, go and connect to the ATC curve. Average cost is 100. So to produce this, if the average cost is 100, what is the total cost? So total cost then to produce 40 units is 100 into 40. That is rupees 4,000. Revenue is 6,400. Cost is 4,000. How much is your profit? 64 minus 4. You get rupees 2,400. Simple as that. Okay. Okay. Then what is the shutdown price? Shutdown price is the minimum average variable cost, where it cuts the minimum average variable cost. So where does it cut the minimum average variable cost? Here. So shutdown price, you can say, guys, is 40, not ATC. Remember, AVC, where it cuts the AVC curve. Okay. So you can say the shutdown price is rupees 40. Simple as that. Yeah. So that's that for today. We've done until 16. So 17, 18, 19, 20. There were a bit more papers to do. We'll do that next class, and then this unit is over. Apart from the 2013 paper, guys, I don't think any other paper was hard. 2013 paper, I'll genuinely accept it was hard, right? So, but if you have understood those questions, right, it would make perfect sense. So during the week, please go through those questions, study what you have done, right? Learn from your mistakes, and please go and do the other questions and come, right? Do from 2017 to 2020 and come. How do I find total cost? To find total cost at 40 units, I found what is the average cost. So at 40 units, the average cost is 100, right? So I connect it to the ATC curve. I go to this axis, I got 100. So at 40 units, if the average cost is 100, what is the total cost? 100 into 40. That is how I got the total cost, 4,000. Okay. So that's it for today. I'll see you all ideally revision class students tonight to finish unit number 8. Others ideally next week. So see you guys. Bye. Thank you for coming. See you. Bye. Welcome.